I've been saying this, of course, for the last few years, but usually in the massive precious metals bull market, silver does outperform. If you look at gold, I mean, the chart looks really explosive, especially like a quarterly chart going back 30 years. And it's amazing that so few people looking at that, which is a good thing. There's no like sentiment is kind of very neutral. There's no hysteria yet. Like there is with other assets like cryptos or even Nvidia. Gold is like climbing like a wall of worry, and no one's focusing on it.
The precious metals market has been experiencing a resurgence, with gold and silver prices climbing to notable highs in recent days. This uptick comes against a backdrop of persistent geopolitical tensions and lingering concerns about the global financial system's stability. Gold, often considered the ultimate safe haven asset, reached a one-week peak of around $2,439 to $2,440 per ounce during Monday's European trading session. The ongoing conflicts in the Middle East have been a key driver as investors seek refuge from geopolitical uncertainties. Silver has also seen significant gains, approaching $28 per troy ounce. Like its more valuable counterpart, silver benefits from increased safe haven demand spurred by global tensions. MarioInnecco, a prominent financial commentator and precious metals analyst, offers insights into the current market dynamics. Innecco points out that both gold and silver performed exceptionally well during the recent banking crisis as investors flocked to these tangible assets. People are recognizing that money in the bank is essentially an unsecured loan to the institution, Innecco explains. In times of financial stress, physical precious metals offer a sense of security that traditional banking can't match. This sentiment was starkly illustrated during the collapse of Silicon Valley Bank, which sent shockwaves through the financial sector. The crisis boosted the appeal of gold and silver and fueled speculation that the U.S. Federal Reserve might need to reconsider its aggressive monetary tightening policy. Looking ahead, Innecco remains bullish on both metals, but has a particularly optimistic outlook for silver. In major precious metals bull markets, silver typically outperforms gold eventually, he states. Please tune in for our exploration of MarioInnecco's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Each year when the banking crisis erupted, gold and silver did really well. And people were rushing to gold because they're thinking my deposits, well, actually, it's not even your money in the bank; it's your unsecured loans to the banks are in trouble. So let me get out of it and cash in and get some real specie gold and silver. And GLD and ETFs won't do. The other factor that is helping gold prices, the fact that a lot of foreign sovereign nations and even people like in China and India, they're still accumulating a lot of gold. I know China officially has stopped buying gold since May, but I think they're doing it through the back door because they don't want the price to take off too quickly because they still have a lot of foreign reserves in fiat currencies, especially in dollars. Silver it is partly monetary, but it's also partly industrial. So it always gets kind of affected more than gold when we see a stock market drop like this. But I still think we're up on the year. And I think we're holding, if you look at the bigger picture, we're still holding some key technical levels. Silver is always more volatile. And if you hold both gold and silver, yes, your silver is kind of not paying off right now, but your gold is. It's okay, I think. And I think eventually silver will, and I've been saying this, of course, for the last few years, but usually in the massive precious metals bull market, silver does outperform. And if you look at gold, I mean, the chart looks really explosive, especially like a quarterly chart going back 30 years. And it's amazing that so few people are looking at that, which is a good thing. There's no like the sentiment is kind of very neutral. There's no hysteria yet, like there is with other assets like cryptos or even Nvidia. Gold is like climbing like a wall of worry, and no one's focusing on it.
Bank of America has recently adjusted its economic outlook, predicting two Federal Reserve rate cuts in 2024, one in September and another in December, followed by four more cuts in 2025. This forecast suggests a gradual easing of monetary policy, which could relieve borrowers and stimulate economic activity. Meanwhile, JP Morgan Chase seeks to resolve a legal dispute related to international sanctions. The banking giant has asked a U.S. judge to dismiss its lawsuit against Russia's VTB Bank regarding a $439.5 million account, frozen due to sanctions imposed following Russia's invasion of Ukraine. This case highlights the ongoing complexities financial institutions face in navigating geopolitical tensions and regulatory compliance. Fitch Ratings has released an optimistic report on the U.S. banking sector, projecting renewed revenue growth in the latter half of 2024. The agency cites increasing capital markets activity and reduced pressure on net interest income as key factors driving this positive outlook. However, financial commentator MarioInnecco cautions that potential vulnerabilities remain. He warns that if the banking sector faces significant pressure, the Federal Reserve may be compelled to intervene again, potentially through measures that could impact the broader public, such as currency devaluation or taxpayer-funded bailouts. Let's get back to the interview.
If you look back, I think it was 08, 02, and even maybe 2020, when the Fed starts cutting, the markets actually keep going down. It's only after the crisis really culminates, like it did in with the Lehman collapse, that things start stabilizing. So yeah, the Fed might do something prior to September, I think September 18th, the second day of their meeting. Like I said in one of my recent videos, the working group on financial markets was created as a consequence of the 87 crash. It was created in 1988, and it put together the SEC, the CFTC, the Fed, and the Treasury to oversee markets. And I think on Monday they were probably very busy on Zoom talking to each other before the markets opened. And I think uh, they helped stabilize a little bit the markets when they opened the regular hour, and that's why I think things picked up again. But this PPT or working group, they can only do so much because the market is much bigger than they are. And the market's resources are much bigger. So eventually, I don't think they can kind of calm things down, but eventually, unless the powers that be want everything to implode and collapse completely, like in 1929 to 1932, they will have to come in and throw the kitchen sink at it again. And by that, I mean cut rates massively, the Fed funds rate, and announce another huge round of QE. We think the banking sector is fine because they saved the day back in March of 2023. Everything's quiet now, but he's right. It could flare up again, and it will be even worse because people have probably gotten complacent, investors and people with money in banks, because they think, well, the Fed and the Treasury bailed everything out last year. So yeah, it feels a little bit like the subprime mortgage crisis. I think a lot of the subprime lenders started going bust in the spring of '07. And it wasn't until the fall of 2008, when Lehman collapsed, that things really started, that the crisis culminated. So yeah, it could very well be that if the Fed sees the banking sector under pressure, that they will save it, because that's what their real mandate is. The Fed's mandate, what they tell the public to maintain full employment and stable prices. That's just for politics. But the real purpose of the Federal Reserve is to allow banks to privatize their profits. But when they lose and the system's under pressure, they will socialize the losses. And by that, I mean they will inflate the currency out of thin air, and that will hurt the public, or they'll bring in the Treasury to bail out the banks, unfortunately.
Gold and silver continue to serve as crucial assets during times of financial uncertainty, offering a tangible sense of security when traditional financial systems face challenges. As we navigate through these unpredictable times, keeping an eye on market trends and economic forecasts will be vital for making informed decisions. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.